If there was one phrase that could summarize the bear market of 2022, it would probably be the Fed pivot. I have never seen so many people all of a sudden analyzing Jerome Powell and his actions, predicting the future Fed pivot and how it's going to make stocks rally and get us out of this massive bear market. And well, they're not wrong. The stock market has historically always bottomed when the Federal Reserve has started cutting interest rates from raising interest rates, which is obviously the definition of a pivot. But just like we've been seeing with the fear mongering happening in the stock market over the past 2 months, the Fed pivot has been blown completely out of proportions, and that is exactly what I want to explain in this video. And strap in, folks, because we have a lot of charts and a lot of numbers to look at. But as usual, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So, to start things off, let's look at this chart right here, which has suddenly been floating on social media and causing a lot of people to panic sell out of their positions as they expect the market to continue to go lower even after the Fed pivots, which is something obviously folks expect to start the next bull market. Well, as you can see, this chart basically shows us that when the Fed pivots, quotation marks, the market actually goes down on average another 28%, unlike what many people talk about on investment communities. Now, although that chart looks extremely enticing, it is probably one of the most misleading information charts on social media, so let's understand exactly why that's the case. Here we have a chart of what the Fed has been doing with interest rates compared to the CPI inflation data. And basically the point that that chart has been making is that whenever the red line goes from a peak to a trough, the market actually goes down in the next 10 months, typically because of a recession. And as you can see, it seems like that is the case. When this inflection happened, which is supposed to be a Fed pivot, then we experienced this recession of 2002, and similar case in 2008 when we saw the great financial crisis right after the Fed started cutting interest rates. But the thing that chart is completely overlooking is the fact that right now the Fed is increasing interest rates not because of a recession or a strong economy, but because of inflation, which is obviously in blue. During both of these times, and even the times back here, which that chart uses as a metric to judge the Fed pivot's effects, the market CPI rate has been below the Fed funds rate. Right now, we're experiencing the exact opposite, which is causing the Fed to increase rates artificially at a record pace, causing the stock market to go down. And I think we've already discussed why the Fed is hiking so fast. They're not doing this because inflation is very sticky or it's potentially a serious problem. They're doing this because of the upcoming midterm elections, where the Democrats are struggling to win over the Senate or potentially even the House, because obviously the consumer has been struggling immensely with prices. So let me say that once more. The only reason stocks have been going down so much is because the Fed is hiking rates at an exponential rate, which means most valuations need to be discounted ahead of time, especially the stocks that are highly unprofitable, which is why growth stocks have struggled so much over the past 2.5 years. And typically when the Fed is pivoting to the downside and cutting interest rates, they're doing that because they all of a sudden start seeing leading economic indicators showing us that the economy is already starting to weaken a little bit. And that is obviously something you're going to see before massive recessions like 2002 and 2008. That right there is the biggest reason why that chart is extremely misleading. The Fed is cutting rates in a normal environment with very low inflation. Right now, they're doing the exact opposite. And because we know exactly what the Fed is looking at for their pivot decision, which is CPI, then we can already know exactly what the Fed might do in the short term by looking at the leading indicators of CPI. And what I've been saying over the past 4 months, leading indicators are already showing us that inflationary pressures are decreasing. The real estate market is already on the verge of going down 20 to 30% over the next year or so, and shipping rates, which have been the biggest cause of inflationary pressures, have already come down to almost pre-pandemic lows. Now, some might say that this level is not down all the way to the 2020 and 2019 levels, which means that the stock market is going to have more downside as inflation is more sticky. But that's not what the point is. The point is the trend of these leading indicators. This is essentially a leading chart of CPI. CPI skyrocketed in early 2021, but shipping rates skyrocketed in late 2020. And the same thing is going on right now. This is potentially what the chart of CPI could look like if the economy is actually weakening at the pace that it is. Now, don't get me wrong, this does not mean the stock market bottom is here. But if you're using the Fed as a reason to not invest in the market, you're doing this completely wrong. Because in the long term, these macroeconomic headwinds or tailwinds have zero effect on the fundamentals of your business, which is exactly why the stock market has gone up for the past 100 years, even though we've always had significant macroeconomic problems during different times. And no, it's not just money printing which has pumped the stock market for the past 40 years. As you can see, inflation is actually lower than it was in 1980, but the stock market is higher. If this money printing and disposable money was the reason for the market being so high, then inflation would be at like 20 to 30%. But the economic machine in America is just so well oiled and so strong that even if the government prints money, it gets absorbed into economic productivity and the standard of living of most Americans. And despite what these recessionary fears are telling us, the US consumer has been holding up extremely strong. And this is a good thing because obviously recessionary fears are driven by a poor consumer. Now, some people might obviously argue that a strong consumer is a bad thing for inflation because it means their prices are going to continue to go higher and the stock market is going to continue to go lower. But those folks don't realize that the biggest component of CPI is not the consumer spending portion, it's actually real estate, rents, and energy. And as I've already shown you over the past few months, oil prices have already started coming down. We're starting to see petroleum reserves increase, and the auto industry and real estate industry is already on the brink of an inflection point where prices are being cut at a record rate. Because guess what? People pulled a lot of their demand forward in 2020 and 2021 when they bought these kinds of goods. If you bought a car in 2021, you don't need to buy another car for another 5 years. So all of a sudden, demand is going to start collapsing, and the overproduction that we saw in 2021 is going to start oversupplying the dealership and lot market. Since cars and houses tend to be the biggest wealth factor for most consumers, this is going to start playing into reduced inflation as people start spending less on goods, which again will drive lower interest rates as the Fed realizes they've done a lot of damage already. And guess what? Many people are forgetting that we're actually in an official recession. And look back at any recession over the past 100 years and tell me, what do you regret not doing during those times? Chances are you would either regret not buying stocks, not investing in real estate, or not starting a business. And right now, with a 31% decline in the S&P 500, we're on track for an average decline of around 36% in all recessionary-induced bear markets. And with the data that I've already shown you about the consumer being already so strong, do you really think this is a real recession, or is this an artificially induced recession by the Fed? And although yes, there's no way to predict what the stock market is going to do in the short term, we can always take advantage of our strategy for dollar cost averaging as the market continues to go down. And chances are we have seen some sort of capitulation in the market because we saw a massive decline since August, which is something many folks simply did not expect. But at least from the time of filming this video, the signs on the daily time frame do look quite bullish because we've been going sideways on the S&P 500 for the past couple of weeks, and although there has been a lot of drawdowns, this particular candle right here really shocked a lot of shorts and put holders. And so there is a high likelihood that we could end up rallying back to this $400 level before obviously potentially seeing more information from the Fed, CPI, and consumer data, giving us an idea of where interest rates will go again over the next 6 months. And you know what's the craziest part about this bear market? 70% of all S&P 500 companies have actually beat to the upside on their revenues. We have never seen this in a recession-induced bear market. Because right now, the exact opposite is happening. The bear market is inducing this recession caused by the Fed. And guess what? In the long term, the number one thing that determines growth in the stock price is the stock's revenue. Nothing else. Not the Fed, not interest rates, not inflation. So at the end of the day, this is what you want to pay attention to, not the drama and the fear-mongering that's going on social media. Because unless you just don't like seeing red in the short term, right now is a time to buy, because nobody will know when the market will actually bottom and everybody will be left as a fool.